Hi and welcome back. This here is now framework.2, part number 2. Again, this is, the information is not being presented in any specific order, so uh, it'll take as many videos as it takes, and I'll just be presenting just general overall concepts as far as financial accounting is concerned. So let's move on to the information. Get me a new slide here, page down. Okay, there we go. And get me a pen. Okay, in framework.1, basically I had talked about um, journals and how that information gets posted into the ledger accounts, and from the ledger accounts we create our financial statements. Okay, now I'm going to get a little bit more, even though that was a framework, I'm going to get a little bit more into the specifics without getting right down to the nitty-gritty. Nitty-gritty is all covered in the textbook. There's a lot of concepts and information in the textbook that needs to be learned, but it goes into this particular framework. Okay, but so I'm going to get into a little bit more in specific, but I want to talk about the idea of accounting periods. Okay. Now, in the book, um, for ease of teaching, all right, they present the information on a monthly basis. All right, which means there's 12 months in a year. All right, so you're talking about having 12 accounting periods. Now, accounting periods aren't necessarily 1 month long. Okay. Accounting periods do vary. For example, if you say I want to have, let's see, an accounting period every 4 weeks, right? Well, there's 52 weeks in a year divided by 4, and that ends up giving me 13 accounting periods. Okay, every 4 weeks. Now think about it. Why would you use every 4 weeks? Well, some months have, February has 28 days. Different months have 30. Different months have 31. Depending upon the business, that makes a difference. It smooths out the information. A month that has 31 days versus the 28, there's a variance there that can be reflected in the numbers. So some businesses use every 4 weeks. Also, they might use 4 weeks for seasonality. You know, like for example, maybe you have an ice cream store where you sell ice cream cones. You're not going to be doing business in December, all right? You'll be doing business more in summer. So having, having the 4 weeks will better gauge depending upon when it starts to get cold and when it starts to get warm. Okay. Also, too, the size of the business. You know, some businesses, as far as they're concerned, since they're not ever going to be getting investors and they're not going to get loans from the bank and they're a small business, they might have only one accounting period and it might be 1 year long. Okay. Um, other ones are, 6 months, right? Which you rarely ever see that. However, every 3 months is another common one. That's quarterly, all right? Uh, this here one is a little bit more common one. So really the ones that you see most are the monthly and the quarterly. So what does that mean to us? Well, at the beginning of an accounting period, let me change the color of the pen here, all right? In the beginning of the accounting period, your general ledger accounts have beginning balances. Now remember, this is the beginning of the accounting period, right? So your ledger accounts have balances. Now, if it's a brand new business, those balances and those accounts are zero, right? But at the end of the first accounting period, let's face it, you've used cash, right? So the assets, liabilities, and owner's equity accounts all will have what we call running balances, okay? And they're known as permanent accounts. But on your income statement and on your income statement, you have revenues and expenses, and they get closed out. They're reduced to zero at the end of an accounting period. We'll get into that into another framework a little bit later on, but those balances end up being zero. So in the beginning of the accounting period, you have balances in the ledger accounts. Then throughout the accounting period, you're going to be making journal entries. You're going to be posting that information into the ledger accounts. And then at the end of the accounting period, you're going to create your financial statements. And after you've created your financial statements, you're basically going to start back up all over again with a new accounting period. Okay. Um, so, during the course of the year, if it's a monthly basis, you're going to have those 12 accounting periods. If your accounting period is every 3 months, yeah, let's just say January, February, March, okay, even though it's 3 months, it's only one period. And instead of starting and ending every month, when you're talking about quarterly here, okay, quarterly, every 3 months, well, on January 1st is going to be the beginning of the accounting period. And at the end of the accounting period, which is 3/31, you're going to have 3 months worth of information in there, right? So you'll start on 1/1, end on 3/31, and you'll create the financial statements based upon 3/31. Then on April 1st, which is the next accounting period, right, you're going to start again using the balances from 3/31, and that'll take you through June 30th, okay, when you're going to create a new set of financial statements and start a new accounting period, okay? So yeah, the accounting period, you always have to be kind of, it's in the back of your mind, as to, what you're doing with the accounting periods, okay, and what you're looking at. As you get into the more detailed information, knowing what a period you're in is going to be important because you don't want to state your financial statements wrong. But all the information, basically, transactions occur, they go into your journals. From your journals, they get posted into the ledger accounts. And then from the ledger accounts, like I said, you create the financial statements. Okay, so we're at 8 minutes, and I could talk about that process a little bit more, which is what's going to be for the next framework, .3. I'm going to talk about, more of the steps that are involved from going from the ledger, the journals to the ledger and to the financial statements. But in order to be able to understand that, you really did need to know about the concept accounting periods, and that's why I presented it. So look at the next framework, okay?